You wake up, you check your bank app, you see your balance, it looks safe. But what if I told you that balance is working harder for your bank than it is for you? That's not drama, that's structure. And today on Money Science AR, we're going to break down something simple, but powerful. Not to scare you, not to blame banks, but to help you understand where your money actually lives and who it's really working for. Let me tell you about Emily. Emily earns $58,000 a year. She's disciplined, she saves carefully. She has $12,000 in her savings account. She feels proud of that number, she should. Saving money is discipline, but here's what Emily never calculated. Her bank pays her 0.01% interest. At the end of the year, she earns about $120. That doesn't even cover a coffee. Meanwhile, that same bank takes Emily's $12,000 and lends it out. Maybe as a personal loan at 11%, maybe as a credit card balance at 20%. On that same money, they earn hundreds, sometimes thousands. Emily isn't doing anything wrong. She's doing what she was taught. Keep your money in a big bank, that's responsible. Safe? Yes. Optimized? No. Here's what most people don't understand. When you deposit money into a bank, it doesn't sit there waiting. It moves. Banks operate on something called an interest spread. They pay you a tiny percentage. They lend your money at a much higher percentage. The difference is their profit margin. That's their business model, and it works beautifully now for them. This isn't a conspiracy. It's simply how banking works. But once you understand it, you stop seeing your savings account as storage. You start seeing it as capital, and capital should earn. Now here's where psychology comes in. Why don't more people question this? 3 reasons. Inertia, fear, familiarity. Inertia says, I've always used this bank. Fear says, what if something goes wrong? Familiarity says, big banks must be safer. But here's the truth. FDIC insurance protects deposits at many online banks the same way it protects deposits at major banks. The protection is similar. The difference? Some online banks offer 45% interest on savings. Same safety, very different return. The system quietly relies on you not comparing. Because when people don't compare, they don't move. And when they don't move, banks don't need to compete. Let's do simple math. If you keep $15,000 in a checking account earning near zero, you might earn $10 per year. At 5%, you earn $750 per year. That's not magic, that's structure. Over 5 years, that difference becomes thousands of dollars. All from moving money that was already sitting still. You didn't work more hours. You didn't take big risks. You just changed where your money lives. That's the power of small structural shifts. Now let's go one level deeper. Inflation exists whether you pay attention to it or not. If inflation averages 3 to 4% and your savings earn almost nothing, your purchasing power is quietly shrinking every year. Your balance might look stable, but its strength is declining. That's the silent loss most people never calculate. Meanwhile, banks are structuring their entire model around earning spreads and protecting their margins. Again, this isn't evil, it's intelligent business. The question is, are you structuring your money intelligently too? Think bigger for a moment. This isn't just about savings accounts, it's about recognizing hidden financial mechanics everywhere. Employer 401k matches, tax-advantaged retirement accounts, credit card reward systems, interest spreads, investment automation. Every financial structure has 2 sides, the side that benefits and the side that funds it. The goal isn't rebellion, the goal is awareness, because awareness shifts you from passive participant to active strategist. Let's introduce someone else, Mark. Mark had $20,000 sitting in a traditional savings account for years. He never questioned it. He assumed that's just what responsible adults do. Then he learned about interest spreads and high-yield savings. He didn't close his checking account. He didn't make drastic changes. He simply moved his emergency fund, automated part of his paycheck into a higher yield account, directed long-term savings into diversified investments. Nothing extreme, but within a year, he noticed something powerful. His money was producing something. That psychological shift changed everything. When you see your money grow intentionally, you start thinking long-term. You start asking better questions. You stop letting your money drift. Let's come back to Emily. Once she understood this, she didn't panic. She didn't blame anyone. She simply opened a high-yield savings account. She moved her emergency fund. She automated transfers. Nothing dramatic, no complicated strategy, no speculation, one quiet shift. 1 year later, she had earned hundreds instead of dollars. More importantly, she felt in control, not because she made more money, but because she understood where her money lived, and that psychological shift matters. And that's the bigger message here on Money Science AR. Financial power is rarely about working harder. It's about structuring smarter. You worked for that money. You sacrificed for it. You delayed gratification for it. So why let it sit somewhere that pays you almost nothing? Money has different roles: spending money, emergency money, growth money. When all of it sits in one low-return place, you underutilize your own capital. Structure creates efficiency. Efficiency creates growth. Growth creates options. This isn't about overnight wealth, it's about compounding awareness. Small structural decisions repeated consistently. Over time, that's how wealth is built. Quietly, intentionally, strategically. Here's your simple action plan. Review where your cash is sitting. Compare interest rates. Open a high-yield savings account if you haven't. Automate transfers. Keep only monthly expenses in checking. Gradually direct long-term savings into diversified investments. That's it. Not complicated, but powerful. Because once you start seeing hidden systems like this, you can't unsee them, and that's when everything changes. Your money shouldn't just be safe, it should be working for you. If this helped you think differently, subscribe to Money Science AR, because here we don't chase hype. We break down systems, and when you understand the system, you stop being on the losing side of it. I'll see you in the next one.